All right, welcome back. Ryan Miller Trading Economics. Today we're going to talk about the housing market, why it is so important in the economic cycle, and what does the housing market tell us about where the economy is headed, and how it flows through to construction and manufacturing. And then sticking with those themes, we're going to take a look at a couple of ETFs in housing, construction, manufacturing sector. Okay, so let's get right to it. So let's start off right away. We have a lot to go through, so I'll try to make this quick. Start off with mortgage rates, right? Interest rates. As we know, the Fed has been tightening monetary policy, which has pushed yields up across the curve. Private borrowing rates like mortgage rates are structured based on bond yields, so mortgage rates have pushed higher. We went from the 3% range to up near 6%, right? And we're on the rise again. Okay, so we've doubled mortgage rates in a very short time frame. If we look at the year-over-year change, this is the largest rise in interest rates in such a short time period since the early 1980s. Okay. As we know, housing is very sensitive to interest rates. So interest rates are a longer leading indicator. They can provide lead time on the economy anywhere from 12 to 18 months. Housing being so sensitive to interest rates also provides us with a long lead time. So housing data are also longer leading indicators. They generally lead the economy by 8 months or so. Okay, so changes in interest rates are going to impact housing first, right, before most other sectors. That's what makes it so vital. That's what makes it so cyclical, right? Housing, interest rates change, impacts housing, which flows through to construction and manufacturing. Those are very cyclical sectors. And those changes, and since they're so sensitive to interest rates, it creates volatility in those sectors in the housing market. And that volatility is what drives cyclical GDP, right? The growth rate upturns, the growth rate downturns. That's why it's so important, the housing market. It drives the business cycle, the changes in growth over the 6 to 18 month time frames. So that's why we're analyzing. That's why it's important, so important to the economic cycle. That's what I want you to keep in mind as we go through this. Okay, so we've had interest rates, a big rise in interest rates, and that's going to reduce the affordability of consumers to purchase homes, and we can see that in the MBA Purchase Index. This measures mortgage applications. It takes out refinancing, which is okay from an economic activity perspective because there's not much economic activity associated with refinancing. So mortgage applications peaked in 2020, have been slowing ever since, substantially. No sign of a bottom. Okay, this is demand in the housing market. If demand is slowing, we should see that reflected in sales. Existing home sales down quite a bit from their peak. New home sales have slowed even more. Right now, new home sales from an economic activity perspective is even more important than existing homes. Even though existing homes make up about 90% of real estate sales, new homes is what drives economic activity. Okay, because new homes, sales of new homes have a very high multiplier effect. Because in order to build a new home requires construction, which requires labor and materials. You move into a new home, you furnish it with new appliances, new furniture, etc. That requires a manufacturing process. So it has a very high multiplier effect. Okay, and that's why it drives most of the economic activity in the housing sector. So as new home sales go, housing goes. As housing goes, the cyclical economy goes. All right. So this is also a chart of single-family homes, new home sales in blue, but I also have it alongside the supply of new houses in the US in red. So as we can see, blue, if we went back to the global financial crisis, it's the housing bubble from peak to trough in new house sales. They contracted about 70%. From the peak in 2020 to where we are currently, new home sales have contracted about 50%. So the volume of sales has fallen quite substantially, the most since the global financial crisis. Okay, and at the same time, we have supply of new homes increasing. Right, we're at about 10.9. The peak of the housing market was 12.2. So we're very close to that figure. Now, what that means is it's going to take about 11 months to clear the current inventory in the new housing market. At the same time, sales are falling. That's going to slow economic activity substantially. Okay. So that's going to put a halt on home builders, right? If home sales are falling and supply is rising, home builders are gonna press pause. We should see that in building permits, right? In order to build a new home, you need a permit. It's been slowing. Okay, if we look at housing starts, which measures new residential construction, been slowing, right? No signs of a bottom. Construction spending, been slowing. Construction spending adjusted for inflation, slowing near zero or at zero, right? If we look at the NAHB housing market index, which measures sentiment among home builders, fallen substantially with no signs of a bottom. So we've just went through all this data in housing construction, which has longer lead times, generally around 8 months. They're all slowing with no signs that they're bottoming. That means over the next, just from this perspective, housing market perspective, that tells us over the next 6 to 9 months, the economy is going to continue to slow. Okay. Now, demand in housing creates demand for durable goods. Durable goods being things like furniture, electronics, appliances, etc. Okay. So demand for housing creates demand for durable goods, which show up in manufacturing new orders. Now, this is where the longer leading data shifts into shorter leading data in the manufacturing sector. So the manufacturing sector is shorter leading data, typically with lead times anywhere from 2 to 6 months. If we look at ISM manufacturing new orders, it has slowed quite significantly. It was below 50 for 2 months. It's popped back above 50, but we're still trending downwards, right? You never want to get caught up too much in that month-to-month noise. If we look at ISM manufacturing new orders minus inventory, it's been slowing since the peak in 2021. We pulled back a bit here this last month, but still below zero. So this is important because if new orders are falling relative to inventory, that's going to put a halt on production, right? Manufacturers or corporations are not going to keep taking in new orders if new orders are falling relative to inventory. They're going to want to get rid of that inventory first. So this leads production. So look at the ISM manufacturing PMI, which measures activity in the manufacturing sector. It's been slowing quite significantly. Still above 50, but slowing, right? And the housing data tells us this data, the shorter leading data, is going to continue to slow in the coming months that we're looking at. Manufacturing supplier deliveries index been slowing since its peak in 2021, right? May 2021, right in line with when growth peaked in 2021. It's been slowing, again, above 50. 50 is at expansion contraction level. So above 50 is still expansion, but at a slower rate. So this tells us that business activity has been slowing. So if supplier delivery times are coming down, meaning it's going to be faster to get your product, that means activity has come down. There's less demand in the manufacturing sector. That's why it's easier to get your product now, because there's less activity happening. Okay. Now, we can confirm this slowdown in manufacturing if we look at capital goods new orders. Capital goods are things like that they're used in production, right? Buildings, equipment, machinery, tools, etc. Right? So if we look at manufacturing new orders for capital goods, adjusted for inflation, peaked in, well, what a surprise, April 2021, when the economic growth peaked. It's been slowing. So that confirms our slowdown in the manufacturing sector. Okay. Now, as production slows, what happens is corporate margins start to get squeezed. Okay. If corporate margins start to get squeezed, there's going to be less spending. Production is going to slow down, like we just saw through the manufacturing data, and then eventually it's going to lead into employment. First thing comes our hours worked. So before corporations lay off workers, they're going to cut hours worked. So if you look at weekly hours worked in our cyclical sectors of construction and manufacturing, it was rising right in line with the growth rate upturn, peaked in April 2021, right when growth peaked, and has been slowing. It's been flat since, but it's come down substantially. Okay. we look at manufacturing and construction employees, it's a big boost with that growth rate upturn. It's come down quite a bit off that peak. It moved up a little bit, starting to roll over now. Now, employment is the most lagging, regardless of what sector you look at. Okay, and his first there's going to be a slowdown in new orders, then production, then they're going to cut hours worked, and then eventually they get to when things persist, the slowdown persists, they cut employment. So this is the most lagging of the two. But out of all the data we just saw, from the longer leading in the housing to the shorter leading in the manufacturing, it says that these this data, employment in construction and manufacturing, should start to come down significantly in the next few months. Okay, if we were to take everything we just looked at and put it into one chart, we can sum it up by looking at residential fixed investment, which is housing, and then personal consumption expenditures, durable goods. So we're looking at housing plus durable goods, right? That drives the cyclical economy. Demand in housing creates demand in durable goods, right? Housing flows through to manufacturing. If those sectors are accelerating, activity in those sectors accelerating, growth will. If they're decelerating, growth will decelerate, right? Cyclical growth, right? Those 6 to 18 months changes. And so this is housing and durable goods as a percentage of GDP. And as we can see, there's been a slowdown prior to every single recession. And here we are, peaked in Q2 2021, right in line with the growth rate peak, and has been slowing. Now, this is as of Q2 2022, but all the data, it tells us that we just looked at over the next 6 to 9 months that the economy is going to slow, says that this should start to roll over as well, or start to head even lower in the coming couple of quarters. Okay, and like I said, weakness in housing and durable goods has preceded every recession, and here we are again with weakness in our most cyclical sectors of the economy. Okay, now what we just looked at are leading indicators, right? Longer leading housing into shorter leading manufacturing, right? And so they don't tell us where we are in the economy, they tell us where we're headed. So we're headed lower. What tells us where we are is the coincident data. If you've watched my video breakdown on the equity indices, I did a whole breakdown of the economy and we got into this specifically. We'll just run through it very, very quickly right now. So if we looked at coincident data, 4 major pieces here: personal income, personal consumption, industrial production, and employment non-farm payrolls. As we can see, income has been slowing, getting close to zero. Consumption is very close to zero. Production, slowing. Non-farm payrolls, employment, slowing. The most elevated of the 4, because again, employment is the most lagging of the coincident data. Okay, so what all the data we just looked at, housing, manufacturing, tells us over the next 6 to 9 months that this coincident data is going to head lower. And before it heads lower, we're going to see it reflected in asset prices. Okay, shortly before you see the coincident data change direction, in this case, we're expected to head lower per the leading indicators, we're going to see it reflected in the asset prices. And we started to see that in equities, right? Like we went over a couple weeks ago. We haven't seen it so much in nominal in bonds and nominal yields, right? They're still rising when the fundamentals say they should be falling. But if you haven't watched my video on bonds that I made last week, I suggest you go do that, because despite what the fundamentals say, that they say yields should be falling, there are a couple of things that haven't happened that need to before it's a good time to buy bonds. Okay, so just a quick recap of that. Interest rates have risen, slowed down housing, which fed into construction. Housing demand has fallen, which has reduced the demand for durable goods, which has slowed down the manufacturing sector, which is going to feed into this coincident data, which over the next 6 to 9 months, which means the economy is headed lower. Okay, so if sticking with the theme of this video, housing, construction, manufacturing, let's look at a couple of those ETFs. So if you look at XHB, right? XHB, which is a home builders ETF, it's been falling, right? If you're not familiar with how I break down the charts, I recommend watching my video framework part 2. where I go over that. Keep it very simple. Look at supply and demand in the context of market structure, pivot highs, pivot lows. So we had this break of this pivot low here, which was in line at the time, early 2022, with the fundamentals, right? Because housing's been slowing since 2021, middle of 2021, all right, spring of 2021. And now we've headed lower. Now we've pulled back. Now we broke this pivot higher. We pulled right into some supply right here, some supply on the weekly time frame, and we've pushed out of here. Okay, so as the fundamental support moves to the downside, we can get a little more aggressive here. Let's hop down to the daily, and we have this pivot right here. This pivot low got broken right there. Now we're pulling back. So if you're going to look to get short as a trader, you're going to look for price to pull into this structure, maybe find some areas of supply, and we're going to look to short at it. If you're already short this sector, maybe it's part of your portfolio. Well, this movement here, we pulled into supply and now broken multiple structures to the downside. That moves in line with the fundamentals. That's what we're looking at for the technicals. That's all we're doing. We're looking for significant moves in line with the fundamentals. That gives you your highest probability. So we got this move down at us, the weekly supply. I broke in multiple minor structures, telling us, okay, that pullback might be over. We're heading back in line with the fundamentals. Let's look to get aggressive here. Okay, so as a trader, if you're going to trade it, you look for a pullback into structure, maybe an area of supply, and look for minor structures to get broken. If you want to get real aggressive, when price gets into that area, you drop down to a 4-hour and look to trade it out of there. Okay, the idea of this is to try to time this better, look for these pullbacks into these areas of structure because it's higher probability, right? We're in supply, we're in an area where sellers should step in, and it reduces our risk and increases our risk to reward. So that's the key here. Okay, or that's the purpose here. The key is looking for those technical moves in line with the fundamentals. And where could we go from here? Well, we haven't quite tested these highs yet from 2020. Come off of a bunch of junk in here, a bunch of retests. There's demand in here, a bunch of stuff, bunch of junk really. Although we did create a new high technically, we broke this pivot high. All right, so we might get some buyers step in at this low here. Otherwise, we're gonna look to trade it down to this high. Okay, if this high doesn't hold, there's some more demand in here. We could look to target, right? And then there's a gap right in here. Theoretically, if we don't get substantial move out of here, you can trade all the way down to this pivot low. Theoretically, right? That'd be ideal. Right, we've got to see what happens, see what the data says in the coming months, right? As it starts to trend lower, got to see what the data says, and then see how the market responds, how the buyers step in or not. But that's where we'll be looking at target here, potentially all the way down to there. XLB, materials ETF. Oops. Sorry, let me get rid of these drawings, and we'll draw it fresh. Okay, so very similar. Broke this pivot low, broke it down, pulled back into the structure, filled this gap, and now on the weekly, we've broken a couple of minor structures right here. That's a good signal that price wants to trade back in line with the fundamentals to the downside. If we look at it on the daily, right? Let's use this. We broke this pivot low right here. Now we're pulling back into this structure. Maybe we find some supply in here and look to get short out of. All right, look to trade it back down. All right. Remember, out of these areas of supply, we're going to look for confirmation. We're going to look for multiple minor structures to get broken, at least 2 of them, to say, hey, we're rolling over, right? We have a high, broke this pivot. We have a high, a low. We're pulling back, looking to form a lower high and take it down, okay, like we've talked about. Now, this has a long way to go before we hit those 2020 highs, right? So this, theoretically, this is where you'd be looking to trade down to, right? From here, looking to take it down to here. That'd be your target. And then similar to XHB, potentially all the way down here. I don't know if it gets there, but theoretically, that's what could happen. PKB, Sorry, I already had lines drawn on here. I forgot to get rid of. Let's draw it fresh. Weekly, similar. So this one's a little different because we already tested these. This 2020 high. Now it broke out back in September 2020 and tested it once. So this is a second test. So some buyers have got eaten up here, and more got eaten up here. Here's your pivot high here. Got stuck in this wick. Now we've broken a structure down, minor structure on the weekly. We look on the daily, we can see it even clearer. We have this pivot right here, broke this pivot low, high, low. We're looking for price to pull back into some supply, look to form a lower high, and we're going to look to take it short, right? This is the second time price reacted out of here. Could get another bounce. Otherwise, we're going to look to take it lower, possibly down to, got some minor structure there, have a gap here. Theoretically, again, could trade all the way down to this bottom of this pivot low, right? But that's the idea. We're looking for moves out of supply, structures that get broken, back in line with the fundamentals. That's the key. That's the highest probability, and we're looking to target these areas. Okay, depending on, of course, what the data says in the coming months as it starts trending lower. Okay, so quick recap: interest rates have risen. It's caused a slowdown in housing, which has trickled through to construction, which has slowed down demand for durable goods, which has slowed down the manufacturing sector, which is over the next 6 to 9 months is going to slow down the economy. It's going to be reflected in the coincident data, income, consumption, production, employment. And before that happens, shortly before, we're going to see it reflected in asset prices, right? And to the downside. And now technically we're just looking for those moves, significant moves, breaking structures, breaking pivot lows in line with the fundamentals to the downside. All right, and that's really it. It really is that simple. Okay, if you want some more information on housing in the economic cycle, highly recommend Eric Basmajian. I'm sorry. I've learned most of what I know about economic cycle. I've learned from this guy. He has some great videos on housing and economic cycle. I will link his information below. Highly recommend it. You will learn a lot. Otherwise, if you have any questions, let me know. You know what to do. Like, subscribe, share, and I'll catch you in the next one.